There are three reasons why mortgage rates are likely to move lower. Lower inflation, higher unemployment, but there's a third factor that people aren't talking about, and it was in the news this week, and it's really important. A couple years ago during COVID, the Fed implemented a policy called quantitative easing, or QE. And what QE was the Fed purchasing mortgage and treasury bonds by the billions to artificially lower interest rates. When the Fed started purchasing significant numbers of mortgage and treasury bonds, the demand for mortgage bonds went up. When demand of a product or service goes up, the price goes up. When the price of a bond goes up, the yield or rate goes down. And the Fed successfully used this to make interest rates at all-time lows in 2020 and 2021. In 2022, the Fed realized they overstimulated, inflation started to creep in, and they flipped their policy from quantitative easing, QE, to quantitative tightening, QT. Quantitative tightening is the opposite. Rather than buying mortgage bonds, they're selling mortgage bonds. They're selling treasury bonds. More supply in the market cause prices to go down. When the price of a bond goes down, the yield or interest rate goes up. And that's why we went from all-time low interest rates in 2020 and 2021 to 40-year highs in 2022 and 2023. Over the past couple years, the Fed has still been implementing quantitative tightening. Mortgage rates have come down in the face of that because unemployment has been increasing, inflation's been cooling. But just this week, on Monday, December 1st, QT, or quantitative tightening, ended. And so now we have all three factors moving in the right direction that should continue pushing mortgage rates lower. Have a great day.